One. Welcome to Wisdom to Wealth. I'm Whitney Hammond, owner of Sovereign Wealth Management, and this is Theresa Pellizzari, Financial Security Advisor with Sovereign Wealth Management. Good morning, Theresa. How are you today?
I'm good, and yourself?
I'm just awesome. Thank you. So thank you, everybody, for joining us. Our mission at Wisdom to Wealth is to help you take control of your money versus your money taking control of you. Today, we're going to talk about life insurance. A lot of people don't understand life insurance, and so we're going to give you a few tips today. How about four little tips today? So Theresa, first of all, how do we determine if or how somebody needs life insurance? How do we determine the amount?
Okay, well, at each stage of your life, you have different needs for life insurance. So whatever stage you're at the time, you take a step back and you determine your current needs. We call that a needs analysis. So we would be looking at your current debt, which could include your mortgage, a loss of income that a dependent was relying on, possibly an education fund if you've been contributing to an education fund, and it could be legacy money, whether it's to your family or your favorite charity.
Or your grandchildren.
Exactly. They fall under family too.
Okay, so, but they're special.
They are extra special. I don't know that yet, but one day I will. Anyways, this helps you take a fact-based,
approach.
Scenario and figure out what it is that you need for coverage. So if you put dollar amounts beside your mortgage balance, your debt, your best guess when it comes to education, and the loss of income, you can times that by 5 times their annual salary, and that'll give you a dollar amount for you to work with. And it's
like a budget. It's like a budget.
It's exactly like a budget. And when we're talking about term insurance is very cheap. It is unbelievable that you can pay this premium for 500,000, a million, 250, whatever it is that your need is.
And with one premium paid, with one monthly premium paid, if the client passes away, that death claim will be paid.
Exactly. It's a solid contract. And I've had clients say to me, wow, this is just too good to be true. I just redid someone's insurance from the bank that was just under $400. And this lady walked away with great insurance, whole life term insurance for under $150. And so when I delivered the policies last week, and she said, yeah, this still feels too good to be true to have $600,000 worth of coverage for this much money and an investment on top of it. I said, well, these contracts that I'm going to put in your hands and review with you, you're welcome to take them to your lawyer, because you will see that it's real. So
that's awesome.
The only other thing I wanted to mention is sometimes we think, oh no, I don't need insurance, I'm young. And yeah, we don't expect you to die when you're young, but there's a term we use is protecting your insurability. So my kids, since they were 13 and 14, had $600,000 worth of insurability protected. If they were ever diagnosed with a blood disorder or whatever, I would be able to make sure they're always covered with at least $600,000 each.
Awesome. Now I heard you mention the bank and you switched the lady from the bank insurance to her own personal plan.
Right.
Can you talk to us about the difference between mortgage life insurance at the bank and straight term insurance at the insurance company?
Right. So we touched on this before, but it is definitely worth talking about again. The very first point is when the bank does your mortgage insurance, they do not do full underwriting, meaning they ask you 5 questions. With term insurance, we ask you a series of anywhere from 30 to 55 questions. And when the contract is delivered, it is guaranteed. And which means that when the bank, if something happened and a claim went through, they would then need to do the underwriting and finish that. So it's not in stone the way term insurance is. The other thing is,
it's not a contract. It's not a solid contract.
Exactly. And the other thing is that with mortgage insurance, because it's third party, banks generally aren't insurance companies, there's obviously the price is higher. So in the example I just shared with you, where this lady was going to be paying just under $400 a month in insurance, her term insurance and her whole life put together was $139. So that's a key point. The rates are significantly cheaper. And then the other piece that's really important, can everyone see this?
Just hold it up.
If your mortgage starts at $500,000 and something happens and you need to put a claim in when it's $250,000 balance on the mortgage, the bank will pay themselves the $250,000, and you will no longer have a mortgage. If you have term insurance,
At the insurance company. Yeah.
Right,
so
from the
I just want to,
insurance company.
this vocabulary here, just want to correct. So if somebody passes away and they have the mortgage life insurance at the bank, the insurance company through that contract will pay the bank the $250,000. Had you had purchased the term insurance directly from a life insurance company, the life insurance company will pay the beneficiary the full $500,000, and then they can decide how much they would like to apply to the bank. So there's great differences in the product, and one of them is that the premium is much higher at the bank, much lower at the Canadian insurance company, and then the benefit, there's a massive benefit. So that's really good to know. And for business owners, I just want to.
Sorry. So yeah, I just wanted to lead you into that. So for business owners, how does that scenario work for them? What sort of answers do you have for them?
Yeah, so business owners would have lines of credit, machinery, debt for machinery, all sorts of different things. And we also have a diagram here of how things work. Is a little bit different. There are significant differences about purchasing your life insurance from a Canadian insurance company when you are insuring your business owner debt. So let's just say there's a $500,000 line of credit or more, loan at the bank, and there is there's a claim at $250,000. So what happens is the bank will pay off that. So if you have it through the bank will just pay off the $250,000, and that's the end. But if the business owner purchases the $500,000 term contract, which probably will be a lower premium, and it will actually be a contract, there's a $500,000 of life insurance. So the premium, you can write off the NCPI, you assign the policy to the bank, you write off the NCPI, and let's just say that the business owner passes away and there's a $250,000 balance. What will happen is through the insurance company, the bank will get the $250,000, but the final $250,000 will come back to the corporation, and there'll be a $500,000 CDA credit in the capital dividend account. So what that means is the business owner will be surviving, the spouse or partners will be able to take an additional $500,000 out of that corporation without paying tax. Business owners, wow, this is a must. You need to speak to a licensed advisor who works with business owners, who can help you through this process, because this is absolutely huge. And not to say anything against the banks, but it's just not their gig. It's not what they do. Mm-hmm. So that's that. And
so Whitney, maybe talk to us a little bit about investments inside the corporation and how they're taxed.
Okay, absolutely. So business owners, if you've been established and you're working for many years, you are budgeting your money, you're saving money inside your corporation, and you save money. It's called retained earnings. Okay, so business owners, it's a goal. You always want to create retained earnings at the end of the year. Why? Because you can pay yourself dividends. Why? Because you can invest in another business. Why? Because you can keep money in there to pay yourself dividend income in retirement years in the future. There's many reasons to do it. So not all of us can be incorporated, but the people who can Take advantage of this. Save your money inside your corporation, because the first 500,000, you're only being taxed at about 15% versus you're going to be paying 40-50% tax on that money. So inside the corporation, when we're investing, the downside is that our investments, let's say you put $100,000 into a fixed GIC at 5%, no such thing, but let's just say you earned 5% on that GIC. You would have to then, at the end of your fiscal year, when you file your tax return, you would have to give back half of that interest. 54% of that interest would have to go to the government. You would keep 46% of it. The government would get 54. This is a raw deal. So we're usually looking, business owners are usually looking for, where can I save this money where I'm not getting eroded by taxes all the time? So a lot of times they invest it back in their business, but they save millions. The business owners have enormous amounts of cash inside their corporations. So here's the sweet thing. This is what we do. We put that money, or some of it, 10%, whatever the business owner decides, and we reallocate that cash and we put it inside of a permanent cash value, whole life insurance policy. Talk to me. I've got $14 million of life insurance. I am happy to show anybody what I own and what my cash value is inside my contract. In fact, one of my contracts this year during COVID paid me $52,000 vested, and I don't have to pay any income tax on it. I did nothing for it. I just sat there and clipped the coupon. I just got the dividend. Every single year, the policy does one thing, and that is it goes up. Never goes down. It's contractually guaranteed to do one thing with the cash value, and that is to go up every single year. It's written in the contract. Starts here and it goes here. And as it's growing, you are not receiving any tax slip. Now, you can do stuff with that money in the future, but let's just say this business owner doesn't need the money. Probably I won't. What do I do with that money? Well, if it wasn't in the insurance, at the time I pass away, there's going to be another layer of tax, because anything inside your corporation, when it comes out, whether you take it personally or whether you die, you owe income tax on it. So when it's inside the insurance policy, what happens is it flows through that capital dividend account, and it's going to go to whoever I've got set up in my will. So in my situation, it will go to my children. And so I'm able to drag that cash out that I saved up over the years and not have to pay a pile of tax. This is the best kept secret. People need to know this. It's the best thing. It's sit down with, again, somebody who is licensed, who's been in the insurance industry for a few decades, somebody who is a business owner, not an employee selling you a concept, but an actual person who owns the contract and has established wealth and understands how to build wealth. That's all I have to say today, and looking forward to another session with you, Theresa. Some more tips from the top. See you later. Thanks everybody for joining
Have a good
again.
day.
Keep your questions coming in because we're reading them.